All right, let's talk about something that looks super complicated but is actually a kind of superpower, reading a company's financial statements. And trust me, by the end of this, you're going to see just how simple it can be.
You know that feeling, right? You open up a report and it's just a wall of numbers. It feels like a secret code meant only for accountants. But what if it's not a code at all? What if it's just a story waiting for you to read it? And that's the big mindset shift right there. We're going to stop seeing this as a math test and start seeing it for what it really is, a storybook, one that tells you everything you need to know about how a business is really doing.
And here's the best part. This whole story, it's told in just 3 main chapters. That's it. Once you get a feel for these 3 parts, you can basically pick up and read the financial story of any company out there.
So let's just dive in and walk through them one by one. This is the framework that'll help you see what's really going on inside any business.
Okay, so Chapter 1 is the income statement. Think of this as the action-packed part of the story, the page-turner. It all boils down to answering one really basic question.
Yeah, it's that simple. Over a certain period of time, say a month or a whole year, did the company actually make a profit? This is always the first question you need to ask.
The easiest way to think about it is like a scoreboard for a game. It adds up all the points the company scored, that's the revenue, and then subtracts all the points it had to give up. Those are the expenses. Whatever's left over, well, that's your final score, the profit. Let's make this super real with a lemonade stand. Say you sell $1,000 worth of lemonade. Awesome, that's your revenue. But the lemons, the sugar, the cups, all that cost you $600. Those are your expenses. So the $400 you have left, that's your profit. See, it's really that straightforward. But here's where you find the first major clue in the story. It's fantastic if sales are going up, but you've got to watch out if profits are going down at the same time. That is a huge red flag. It means costs are just spiraling out of control and eating up all the hard work. Okay, on to Chapter 2. So making a profit is great, but that's only part of the story. Is the company actually building wealth, or is it kind of fragile? That's what the balance sheet tells us.
This chapter is all about a different question. It's not about performance over time. It's a snapshot of right now. It's all about balancing everything a company owns against everything it owes.
Yeah, think of it like a photograph, not a movie. It captures one specific moment. It lists all the company's assets, that stuff it owns like cash or equipment, and it lists all its liabilities, that's what it owes, like bank loans. And equity, well, that's just what's left over for the owners. It's the real net worth of the business.
And this is where you can spot some serious risk. A company with a mountain of debt compared to what it owns has very little equity, very little cushion. It's like walking on thin ice. One wrong step and the whole thing could collapse. You want to see a business with a solid foundation of equity.
Okay, time for our third and final chapter, the cash flow statement. And I gotta say, this one is the reality check. This is where the story gets really, really honest.
So here's the crucial thing you have to understand. Just because the income statement shows a profit, that doesn't mean there's actual money in the bank. This statement, the cash flow statement, tracks the real, hard cash moving in and out of the business. There's a famous saying in finance, and it is, profit is opinion, cash is fact. Let that sink in. A company can make a huge sale and record a big profit, but if the customer hasn't paid their bill yet, there's no cash. That's why profit is just an opinion. But cash, sitting in the bank, that's a hard fact. It's the oxygen a business needs to survive. And this is maybe the most dangerous trap in business. A company can look profitable on paper, but if its actual cash is going down every month, it's in deep, deep trouble. That cash could be tied up in inventory that isn't selling or stuck in unpaid invoices. This is exactly how so-called successful companies go bankrupt.
So there you have it, our 3 chapters, the income statement, the balance sheet, and the cash flow statement. On their own, they're interesting, but the real magic happens when you put them all together. That's when you see the complete picture. So this is how you read the full story. You never, ever just look at one chapter. You ask, in order, first, did it make a profit? Okay. Second, is its financial footing solid? And finally, the ultimate test, does it actually have the cash to keep the lights on and grow? And look, if you only have 60 seconds, this is your cheat code. Just ask these 3 questions. Are profits growing? Is their debt manageable? And is the business generating actual cash? If you get a yes on all 3, you're probably looking at a pretty healthy company.
So let's totally reframe this. These documents are not boring accounting homework. They are truth machines. They cut through all the marketing hype and tell you what is really going on.
And now, you have the key. You know how to read the story. And I promise you, once you start looking at any business through this 3-chapter lens, you'll start seeing the real story behind the headlines. You'll never look at them the same way again.